Welcome to Lab 16, the 6-step process, steps 1 through 3. The purpose of this lab is to practice the first 3 steps for identifying a quality trade opportunity. We started with learning zones, then we learned trend, and now we've learned the specific application of zones through setting the curve. These all come together to help us identify and qualify an opportunity. Not only do we look at zones on a smaller time frame, but we look at the overall setup and the overall context by combining trend and curve. During that time, we learned things in the order they needed to be learned in order for it to make sense and to build on previous lessons. However, when we actually look to place a trade, we'll do things in the order they need to be done, which we'll go over during this lab. We'll start on the high time frame to identify the curve, then move to an intermediate time frame to identify the trend, before moving to a lower time frame where we actually find our entries and exit zones and set up the trade from there. Go ahead and take your chart to XLE on a monthly time frame. I've already completed this particular chart, but we're going to go over it together. Now, using the 5-step zoning process, I've identified a monthly high time frame supply distal line at $93.31 and a monthly high time frame demand distal line at $51.66. Next, we take the difference between those 2 points and divide that range into thirds to set the retail, equilibrium, and wholesale curve ranges. So in order to locate your distal lines, you're going to start at current price, and I've set this marker here for September 19, 2022 to serve as a marker for the current price. So from current price, we're going to go up and left to identify a high time frame supply distal line in order to set the boundaries for the curve. Now, typically, your supply zone formations, you're going to look for a rally-based drop or a drop-based drop. However, there will be occasions where you will not find a typical supply zone formation. So in that case, when you're trying to set the curve, you're going to use the most prominent high in order to identify the boundaries for your curve. So in this case, we can see that we have a high of $93.31. So I've set the boundary for the high time frame supply distal line there. Okay, so now going back to current price, we're going to go down and left, this time looking for a monthly high time frame demand distal line, which we've identified at the bottom of the screen. So from current price, we come down and left, not cutting through any candles. And we have a typical demand zone formation here. This candle opens here at $58.04. It closes at $54.59. We have this candle which opens at $55.87 and closes at $55.50. Clearly we can see that it closes in the range of the previous candle. And if we come another candle over, we can see that this candle clearly extends beyond the range of this basing candle. And if we look at the price difference, we see that this candle has a high of $57.87. And we know, as we've previously identified, that this candle opens at 58.04. So this candle extends beyond the range of this basing candle. And this candle clearly extends beyond the range of this basing candle. So we have a drop, base, rally formation. So in order to set the boundaries for the curve, we could draw out a typical demand zone by using the top of the body or the highest body within the base, which would be here. And we would use the lowest wick to identify the distal line. So the top of the body would be the proximal. The lowest wick would be the distal line, okay? But for purposes of setting the curve, we only need the distal line. So we have our demand distal line here, and we have our supply distal line here, all right, at a high of 93.31. We're going to annotate or note the prices of our 2 distal lines, and we are going to subtract the demand distal line from the supply distal line in order to come up with the difference between these two price points. We are going to take that difference and divide it into thirds. And if you do that, you should come up with $13.88. This is what we are going to refer to as our curve factor. You are then going to take your curve factor and subtract it from your supply distal line. That will mark the retail price range for the curve. You are going to take your curve factor and add it to your demand distal line. That will give you your wholesale price range for the curve. And then everything else in the middle would be considered equilibrium. Now that we have our boundaries, we want to look at how price is moving within those boundaries. So we want to go to step 2 and check the trend. So to do that, we're going to drill down to the next lower time frame, in this case from the monthly to the weekly, and then from our marker, which is set to serve as current price, we'll identify the 3 most recent segments to check the trend on a weekly time frame. So in this case, I can click on the time frame and go from the monthly to the weekly. And then from there, I'm going to go to current price and identify the 3 most recent segments. So from current price, this candle closed here, but we're going to use the lowest point within this candle, and we would go up to the highest point. That would be the first segment. Then from this price point down to this price point would be the second segment. And from this price point up to this price point would be the third segment. Now I did go back a little farther, but all you would need to do to identify the trend is to look at the 3 most recent segments. But I chose to go back farther just to get an idea of what took place. I can see that at one point there was an uptrend. Then price broke below the controlling swing low in the uptrend, which means that the uptrend is now discontinued. And then we have price coming back up. Doesn't get past the previous high. We have price coming back down, but it doesn't get past the previous low. So just looking at the 3 most recent segments, we can see that we are currently in a sideways trend. If you recall that whenever you are trading or looking to place a trade within a sideways trend, you will always use the extremes within that sideways trend. So if we go to current price, we can come up and to the left and see that we have an extreme point here. We can come down and to the left to see that we have another extreme here. But in order to identify the particular zone, we would need to drill further down to a lower time frame from the weekly to the daily. So now that we've identified the trend, we want to identify an entry zone to go with the trend and an opposing zone to set our target. To do that, we'll drill down to the next lower time frame, and again we'll use the 5-step zoning process, but this time we'll use it to find our points of entry and exit. So to do that, I click on the time frame button again, and this time I'm going to go from the weekly to the daily. And recall that whenever we are trading in a sideways trend, again, we will always use the extremes within the sideways trend. So we have our 3 most recent segments, and we have the highest points within those segments. So we have a supply zone here. And again, whenever we identify a supply zone, we go with the lowest body within the base. And since we only have one basing candle here, that's pretty much a no-brainer. We have a rally, base, drop formation. So we use the lowest body to the highest wick. And to identify the demand zone within a sideways trend, we go to the lowest extreme. And we can see that we have a demand zone here. We have a drop, base, rally. Now you'll notice that both of these candles are red. Even though these candles are red, they are a part of the move out in price, because even though they're red, each one of these candles closes higher than the previous candle. We see this green candle closes here, and even though this candle is red, it closes above the previous candle. We move one candle over and see that this candle is also red, but it likewise closes higher than the previous candle. So even though these candles are red, and we can see that during this particular time frame, which would be 8 hours, that's a trading day because we're on a daily chart, the candle opened here and closed here. So within those 8 hours, it did close lower than when it opened. But if we look at the overall context, this is a move out in price. Okay, so we can identify this as a demand zone. We have a drop, base, rally formation. So we would take the lowest point within the sideways trend, and we can clearly see that this is the lowest point. This is the highest point, so we would identify our supply zone here and our demand zone here. Now, to determine whether you want to go long or short in this particular situation, you may want to go back one time frame to your weekly and look at the overall movement in price. You may look at news and current events to make that decision. I won't give you an answer to that particular scenario. That would be left up to yourself and the research and analysis that you've conducted at that particular time regarding that particular asset. To assist you in your analysis, you always want to remember to use the odds enhancers. So as you can see, I've already done that. This particular zone scored 2 out of 2 points for strength. Recall that when you're looking at strength, you want to look at move out and breakout. Okay, so just to reiterate, move out refers to price moving away from the zone equal to or greater than 2 to 1. So in order to do that, you're going to look at the width of the zone, and you're going to want to see that price moves out at least twice the width or height of this zone. So in this particular case, we can see that price moves out to this candle here before it starts basing. Okay, so that's what you want to look for. So in this case, strength is going to earn 1 point for move out. The other thing you want to look at is breakout. You want to go back and identify a demand structure, which we can see that we have one here. We have demand, we have a rally, base, rally formation. So we've identified a demand zone here, top of the body to the bottom of the wick when it comes to identifying demand zones. And we can see that price broke beyond the distal line of that demand zone. So in that case, price or strength would earn 1 point for move out and 1 point for breakout. Okay. When we look at time, we want to look at the number of basing candles that are in the base. In this particular case, we have one basing candle, and anytime you have 1 to 3 basing candles, time is going to earn full marks. The other thing you want to look at is freshness. Has price returned to the zone? In this case, it has not. Now, the reason freshness is important is because what we are relying on is that when price returns to this zone, we'll get a reaction and price will move away from this zone. If price has already returned to this zone, then what that does is it dissolves any unfilled orders that were waiting in this zone. The whole point of identifying zones, we're looking for unfilled orders. All right. So that's for the supply zone. You also want to score your demand zone. All right. So again, we're looking at strength, move out and breakout. We're looking at time, which is the number of basing candles. We're looking at freshness to see if price has returned to the zone. So anytime you identify a zone, you always want to use the odds enhancers to score the zone. And that will assist you in determining, do I want to go long? Do I want to go short? In this particular case, both zones scored full marks. You have a total 5 out of 5 points for the supply zone. You have a total 5 out of 5 points for the demand zone. So now it's a matter of, are you comfortable going long? Are you comfortable going short? Maybe you want to look at the amount of risk that you're taking for the demand zone. This is 2.01, $2.01. This zone here is smaller. It's $1.03. You might use that to determine, do you want to go long or short? All right. And then again, you might look at news. You might look at current events, the particular asset that you're trading. All of these factors can help you determine whether you want to go long or short. There is no right or wrong answer necessarily. Trading is about minimizing risk. So you need to perform your analysis per the trade strategy using these items to help you determine which trading style or objective is better for your particular situation. Okay, so for this next exercise, the first and final, you'll have a chance to try this on your own. Go ahead and take your chart to AAPL on a monthly time frame. Now go ahead and place a vertical timeline anywhere on the chart and go into the settings cog for the timeline and change the date to September 20th, 2022. Now what you'll do is go through the steps to identify the curve, the trend, an entry zone, and a target zone. Go ahead and pause the recording, complete the exercise. Then once you are done, unpause the video and we'll take a look at it. Go ahead and pause the video now. All right, and the correct answer is, and here we can see the correct response. Now, mind you, we are currently looking at the monthly chart. We will drill down into the intermediate weekly time frame to look at the trend, and then we'll again drill down further to the daily chart to identify entries and exits. Now, also, your chart may be slightly different than mine. Per the trade strategy, I will go over why I believe this is the correct response according to the trade strategy, not necessarily the right answer as per your investment. All right, so when we look to identify the boundaries within the curve, we're always going to start at current price. All right, to identify supply, we go up and left. And as I mentioned before, there will be occasion where you will not find a typical supply zone formation. Recall that our supply zone formations are going to be a rally-based drop or a drop-based drop. We do not have that here. So in that case, we're going to use the most prominent high. In this case, it's $182.94. So we place our monthly high time frame supply distal line there. Going back to current price, we're going to go down and left, this time looking for a demand zone formation. And again, we don't cut through any candles. So down and left, coming around these, looking for a demand zone formation. Now, you may have identified this demand zone here from the top of the body of this candle on down to the bottom of the wick. But if you look, you'll see that this candle is already penetrated that zone. And per the trade strategy, when we identify zones, we only want to identify fresh zones. If you come around this candle again, not cutting through any candles and only taking fresh zones, we would have to come all the way down here to identify this drop base rally formation. So just to go over it, we see that this candle here has a high of $76 even. This candle has an open of $76.08. So this candle does extend beyond the range of this candle, even though it's only by pennies. We see this candle closes within the range of this candle, making it a part of the base. So we have two candles in our base. And this candle extends beyond the range of both of our base and candles, making this the leg out. This would be the leg in. And per the trade strategy, we take the highest body within the base. We use that as our proximal line. And our distal line in a drop-based rally formation would go at the lowest wick within the entire formation for a drop-based rally. All right, so we place our monthly high time frame demand distal line there. Per the trade strategy, we're going to take the difference between our two distal lines and we're going to divide that area into thirds. Once we've done that, we should come up with $43.26 in this particular case, and that will refer to our curve factor. We take our curve factor, subtract it from the supply distal line, and then we add it to our demand distal line to carve out our wholesale, equilibrium, and retail price ranges. If you're comfortable with using this as a high time frame demand distal line, I think that may be a good idea. I myself am not convinced that we'll ever see these low prices from Apple, at least not anytime soon. Again, we can see that price did get this low and was soon pushed back up. It came up to here, and then it started to come back down. So if I was actually looking to place this trade, I probably would use this as the high time frame distal. But again, for purposes of example and going through the trade strategy and sticking to the trade strategy verbatim, I'm only going to use a fresh zone, which would bring me to this demand distal line here. Okay, so now that we've got our boundaries for our curve, we want to go ahead and move from the monthly into the weekly time frame in order to identify the trend. So to do that, we're going to go ahead, or I'm going to go ahead and zoom in just a little bit. And again, we're going to go back to current price. We're going to identify the three most recent segments for the trend. So we have a low price here. We come up. That would be the first segment. From this segment down to this move in price would be our second segment. And from this low price point back up to this price point would be our third segment. Now, you may have chosen to go with something that was a little more refined. Perhaps looking at the third segment, say you went from here to there, from there to there, and from there up to here. However, to me, this just seems like chop, what a lot of traders will refer to as chop, where price is kind of moving around within a confined area, but does not necessarily speak for the overall move in price. And so we want to be able to identify the overall move. So rather than going so refined, like from here to there and from there to here and then back up, we want to look at the overall move up here, from here to there, and from there to here, to identify the three most recent segments in order to get an idea of the type of trend that we are in. So when looking at this particular trend and the three most recent segments, we don't see any higher highs and we don't see any lower lows. We do see price moving back and forth within a specified range. We do have some confirmation because we have three segments, and we also have price coming up to a range that it was previously in before it starts to head back down. So anytime you are trading within a sideways trend, you always want to trade within the extremes until an uptrend or a downtrend can be identified. All right. So now that we have our trend, we're going to drill down to the next lower time frame to identify our entry and exit zones. So we're going to go from the weekly now down to the daily. Zoom in just a bit so we can get an idea of what we're actually looking at. So again, starting from current price, we're going to go to the extreme in order to identify our supply zone. Now, you may have look at And in order to identify the supply zone, again, we want to look at the extreme. But in this area, we can see that these particular zones are penetrated by this movement in price over here. So we're going to go with the most recent segment for the supply zone, in which case we have a demand or supply zone here. Looking at the lowest body within this particular base, we have a rally base drop formation. So we use the lowest body within the base. In this case, it's only one candle up to the highest wick. And if we go back to current price, looking for a demand zone, using the extreme, we would use this demand zone here. We have a drop base rally formation. However, if you look at this particular zone, when we look at strength, we don't have a move out that is equal to or greater than 2-to-1. And we also do not have a breakout where price moves beyond the distal line of a supply zone formation or a formation that represents selling. So we see price coming down here, then it comes back up to this price point here. The high on this candle is 137.34. We have a move out of price from these basing candles, but it does not get beyond that price point. So strength would earn 0 points. So in that case, if you recall, whenever a odds enhancer scores 0, you do not use that zone. You delete that zone. It doesn't exist. We're moving on per the trade strategy. Okay. So again, in sticking with the theme that we're going to use the extremes when trading within a sideways trend, this would be the next zone. And in this particular case, we have one basing candle here. This would be our leg out. This would be our leg in. One basing candle. We have a move out. This candle closes here. This candle closes here. This candle closes here. This candle closes here. And finally, this candle closes here. So clearly we have a move out equal to or greater than 2-to-1. We also see a supply formation here. This would be the leg in. This would be our basing candle. This would be the leg out. This is a rally base drop formation. We take the lowest body within the base. And within a rally base drop formation, we take the highest wick within the entire formation, which would be one of these two. And clearly we can see that price moves beyond either of these points within this within the rally base drop formation. So strength in this case would earn 2 out of 2. We have one basing candle, so time would earn full marks. Now we do see that price did come back into the zone, but did not penetrate the zone 50% or more. So in that case, freshness would earn 1 out of 2 possible points for a total 4 out of 5, which is still a decent score when looking at a zone. Okay, so I am comfortable identifying this as either an entry or an exit, depending on whether you would prefer to go long or short within this particular asset. All right, so that will conclude this particular lab. Before you move on, using the entry and target zones from this lesson, score out the odds enhancer for profit zone. Look at your demand zone and ask yourself, how far is the opposing quality supply zone? Is it equal or greater than 5-to-1? Is it equal or greater than 3-to-1? Or is it less than 3-to-1? Also, look at your supply zone and ask yourself, how far is the opposing quality demand zone? Is it equal to or greater than 5-to-1? Is it equal to or greater than 3-to-1? Or is it less than 3-to-1? And if you have not already done so, complete the lab 6-step process, steps 1 to 3. Hope to see you in the next video.